Let's broaden out this conversation, bring in another voice. That is our friend, Dan Suzuki. He is the Deputy Chief Investment Officer at Richard Bernstein Advisors. All right, so Dan, you think that the market has not put in its top for the year. You remain optimistic.
Yeah, I mean, listen, there's like 2 months left in the year, so anything can happen, right? But I think
there's also an election.
There's also an election.
Bring that up.
Yeah, but when you think about it, I mean, the things that matter most for the markets are probably profits and liquidity. Profits, as you guys have been talking about for the last 10 minutes, profits are accelerating and they're broadening out. And liquidity is actually really strong, and the Fed's cutting interest rates. So I think with that, those two levers, the market still has legs.
Do we look at the banks and their earnings? And they were good. But do we look at them as a measure of anything other than the health? Because Goldman Sachs, I don't think, represents the American economy. Is that a fair statement? No offense to Goldman. But so the bank earnings have been good. That's nice. It's a good start. Wall Street loves it. Does it tell us anything more about how every other company is going to do?
I think it does. I think there's a broader theme happening here. First of all, it wasn't just the investment banks. You're seeing it from all the financials that have reported so far. You're seeing better than expected results, and things are pretty good. Are they, going to the moon? No, but things are pretty good. But I think it extends beyond the financials. I think even the non-financials that have reported already, which is just a handful, are telling you that things are not as bad as people were expecting, and things are actually getting less bad in the areas that have been beaten down. And I think that's the big opportunity. People forget that huge portions of the S&P 500 are still in a profits recession, but they are exiting that profits recession. I think that's the opportunity. That everybody's left these for dead because their growth has been terrible, but it's getting less terrible on its way to good.
So, Dan, we talk about the elections. We know about geopolitics. And I say this, I mean, you at times have been concerned about this market. And I think at Bernstein, you guys do a great job of actually being cynical and trying to figure out where the problem is. Why has the market turned the corner out of this Fed meeting? Did the Fed give us the green light? Because we get this sense that, I agree with you. Look, I think the market's going higher into year end. I don't see any surprises from the Fed. I think there could be a bad data point or two. But outside of a political cycle and geopolitics, I think we're going to set new highs all the way through. How have you gotten more constructive?
I think that it's really just been a function of the market moves in these like sort of 1 to 2 month narratives, and the narrative shifted way too far to things are terrible. Growth is slowing down too fast, and that's why the Fed has to cut 50 basis points. If you look at all the data that we've gotten since then, it's telling you that things aren't that bad. Whether it's from the earnings companies, the economic data, you're seeing economic surprises pick up. And on top of that, you have this sort of China stimulus story that's also playing into this growth recovery. So when you put all that together, we're looking at a world that's actually growing pretty decently with actual upside relative to beaten down expectations. I think it's just fundamentals.
So, Dan, just looking at the market and thinking there's upside, do you think the rotation moves things around and we get upside from different places? And if so,
I mean,
where
absolutely. I think the risks lie. The biggest concentration of risk is going to be in the most crowded, expensive names. So I think I'm excited because a narrow market is an unhealthy market. And I think as it broadens out, it's really just following the fundamentals. Yeah. It's not like it's happening in a vacuum. Earnings growth is broadening out. I think this quarter, you're probably seeing more sectors and more companies report positive and improving earnings growth. And in that context, it makes sense that the performance will follow through.
A lot of love around the table. I'm gonna have to throw a little cold water. The late great Charlie Munger had a process of thinking he called inversion, and he would basically look at what could go wrong and work backwards from there to try to come to he didn't start with the bull case. What's the worst possible outcome, and then he kind of worked down from there. I think it worked out for him, by the way.
Yeah.
What are the risks to this market? There's a lot of geopolitical stuff. I get it. We got an election. I get it. Your job is also to look at the risks. What's the downside risk here?
Well, I think, first of all, it depends on your time horizon, Brian. I mean, again, on such a short time horizon, anything can move the needle. And again, these things move in 2 month narratives. But, fundamentally, probably the biggest risk is that, things actually, the slowdown that people are worried about actually comes through. And there's a million things that you can point to that would actually support that. I think there's also a million things that would support the opposite. But listen, you're seeing, credit stress among the low-income consumers. You look at sort of the retail earnings, everybody's excited, the consumer's strong, but they're all negative numbers that these companies are posting. And so when you put all that together, if the China stimulus doesn't come through, there's a lot of reasons to think that, the U.S. economy, everybody knows, is consumption driven. Yeah. That consumer is, the drivers of that consumer are slowing. gradually. And I don't think they're falling off a cliff. But if that continues, that's the worst case scenario, that this broadening out is sort of temporary and it's a head fake. That's the concern.
Well,